Welcome to RCLCO's December macroeconomic update. I'm Scott Bommarito, and today we'll briefly look at the latest data points from the U.S. economy as the year comes to an end. The Federal Reserve has begun lowering interest rates over the past several months, with a cut of 25 basis points in November, which followed September's cut of 50 basis points. The Fed is currently meeting, and an additional 25 basis point reduction is all but certain at this point. The final announcement is due within just a couple of hours. Economic data has remained strong, which has caused market participants to generally expect the Fed to pause its interest rate cutting regime in the new year. Futures markets are currently priced to expect 50 basis points of further reductions over the course of 2025, but there's considerable variation in that forecast and broad agreement that at least the January meeting of the Fed will hold rates steady. The 10-year U.S. Treasury rate is likewise expected to remain higher than previously thought next year. Most economists forecast the rate to hover somewhere between 4 and 4.5%. Inflation remains a complicating factor for monetary policy. November's CPI report showed that the headline inflation figure rose 10 basis points to 2.7%, while core CPI held steady at 3.3%. Worryingly, both indices accelerated over the past 3 months. On an annualized basis, headline and core CPI rose 3% and 3.7% respectively, so notably above the Fed's 2% target. Although economists continue to expect inflation to moderate toward that target, the last mile of inflation has proven frustratingly stubborn. Headline CPI has been volatile over the past year and particularly slow to moderate, especially over the last 12 months or so. The labor market also rebounded with a strong report in November. Employment growth shot up to 227,000 after a depressed October reading, which was due to adverse weather events and strikes in a couple areas of the country. Monthly employment figures are prone to notable revisions, but a strong initial reading for November indicates that the job market still has wind in its sails. Elsewhere, the unemployment rate rose 10 basis points, but remained low at 4.2%. Wage growth also held strong. Annual growth was steady at 4%, and over the last 3 months, wages grew at an even stronger annualized rate of 4.5%. So wage growth has outpaced CPI inflation recently. That's translated to real wage increases for employees. RCLCO's full monthly macroeconomic report featured this chart as its November chart of the month. If you're not a subscriber already, feel free to reach out and we'll be happy to add you to our distribution list so that you can receive our full report each month going forward. This chart shows monthly principal and interest payments on 30-year mortgages at prevailing interest rates and median, new, and existing home prices. As interest rates fell over the summer, mortgage payments also declined. However, the recent uptick in interest rates drove monthly ownership costs higher in October. Monthly payments on existing homes, which constitute the majority of homes sold, had declined for 3 consecutive months from a high of $2,540 in June to $2,240 in September. With October's increase in rates, monthly payments rose $60 month over month to $2,300. Now, monthly ownership costs will continue to impact both for sale real estate and rental housing fundamentals in 2025 and beyond. A prolonged period of elevated interest rates will further depress ownership affordability, and that will increase demand for rental housing, consequently pushing up rental rates and vacancies. That concludes our final economic update for 2024. We wish you a Merry Christmas and Happy Holidays, and we look forward to seeing you back again in the new year.